The European Central Bank has just eased monetary policy. The US Federal Reserve is widely expected to shortly tighten interest rates. Welcome to the world of central bank divergence. With me here to discuss the implications of this are Martin Wolf, the FT's chief economic commentator, and Stephanie Flanders, chief market strategist for Europe at JPMorgan Asset Management. Welcome. Stephanie, can I start with you? I mean, does it make sense? Do you think that these central banks have sort of taken the right decision for their relative areas?
Look, I think we've had a period for at least 18 months where the two regions, these two key parts of the world, were at very different stages of a cycle, and the US was moving in the direction of possibly having slightly less stimulative policy, whereas clearly the ECB, if anything, one has felt was not doing enough throughout that period. So in that sense, the fact of divergence reflects a reality about where they are in their respective recoveries. But I don't think we shouldn't overdo it in the sense that I think we would expect, because of the nature of this recovery and certainly the inability, it seems, to generate much inflation in any of the developed economies in this cycle, I don't think we would expect policy is going to remain very stimulative in both countries. The only issue is whether the ECB needed to do more and whether the Fed needed to at least make a start on this process. And I think it was more, the ECB didn't. I think it disappointed the markets, but markets had got to an extraordinary position and sort of expecting more and more and more. Actually, what they did, I think, made a certain amount of sense, as long as we understand that they may well have to do more and will continue to have to at least have bond purchases going well into the future, I think.
Right. I was going to ask you about what you thought about the ECB, but you've answered that. Martin, were you disappointed by what the ECB did?
No, I think they handled the guidance, the indication of what it meant rather poorly. But it's clear that they've clarified it, and they would insist they meant it all along. Mario Draghi made a speech in New York afterwards which said, essentially, we're going to go on for as long as it takes as an absolute commitment. There are no limits, very clearly stated, on our purchases, and we will continue until we meet our mandate. And at the moment, they're way below their mandate. If you look at core inflation, it's roughly half of the target of 2%. It's been that low for years now, so they've still got a lot to do. They confused it a bit. They've still got ammunition, and they're going to keep going. He got this through with a pretty strong majority, clearly, and if necessary, they're going to keep going. So they've made it clearer. In terms of substance, I think there's a reasonable chance this policy will work in the end, but only a reasonable chance. The other policies in the Eurozone remain profoundly unsupportive.
Can I just ask? Sorry, Stephanie.
No, I was just going to say, and I think one of the things about the policy, if anything, the disappointment was reflected in the fact that the euro strengthened when everyone had been sort of expecting it to weaken. But in a sense, I thought it was helpful for the signalling to be more on the state of the domestic economy in the Eurozone and what they were going to do to confront that, and not to be constantly appealing to this cheap euro policy, which in many ways doesn't necessarily fit the fundamentals. It shouldn't be the core of their policy.
Right. Martin, can I just come back with you on the question of divergence? Do you see this causing any problems?
It's very difficult to predict how relevant asset prices, and the most important is the exchange rate, will respond. And as Stephanie's already indicated, predicting the way the exchange rate market operates is really a fool's game. It's very, very difficult to do. But it's clearly possible that if we see over the next few months the likelihood of further divergence, and also it is possible, as the markets get into their minds that they really are on a divergent path, that exchange rates will diverge, and that is likely to add to the difficulties that a number of countries have, particularly countries which have very, very large dollar borrowings. If the dollar goes on up, and it's gone up a lot, and particularly for countries and producers, companies that are very, very exposed to the commodity cycle, which is a disaster for them at the moment because of the collapse of commodity prices, that combination could lead to quite a number of countries and companies and financial systems, mostly in the emerging world, into quite serious difficulty. This will be a small part of that story, but it might be a contributory part.
Just like to ask, I mean, we've obviously focused mostly on the ECB and the Fed, but I mean, how do you think other key central banks are going to respond now? Particularly, Stephanie, Bank of England has sort of been standing on the sidelines.
Well, it is interesting. I mean, the Bank of England has been playing a difficult game because there is this very long list of central banks in the developed world that have tried to raise interest rates since the financial crisis and then have had to reverse that decision. And the Bank of England was certainly uncomfortable, or much though it protests its independence from everybody, including the Fed. The Bank of England was clearly uncomfortable being out there on its own. And there's been a lot of signalling around a very late 2016 rate rise for the UK. I think if we go into 2016, having seen a first Fed rate rise and having seen the world not come to an end, some of those expectations might come a bit nearer. But remember, they've also got to consider market dynamics around a possible referendum in the UK. So I think that their life is very complicated by the currency, even more complicated than for the Fed, and a bit complicated by UK politics.
And it's worth adding a small thing. I mean, our inflation rate is really very low, but
we have some evidence of wage pressure, which we don't have anywhere else.
But it's well below. I mean, in the case of the Fed, core inflation is close to target. So ours isn't. So I think it's perfectly reasonable for the Bank of England, looking at what's going on in Europe, to wait and see, and wait a long time. But then I think the Fed should wait and see too. So I'm generally dovish on this. But I don't think the Bank of England has to follow the Fed, but it might.
We're basically out of time, but I just want to squeeze in very quickly, Martin. I mean, should we also be looking at the People's Bank of China and the BOJ as well? I mean,
well, the BOJ is going to do more of it. So it's where the ECB is, but even more. That's clear. And the People's Bank, in my view, is following the same course. I mean, essentially, they have a very big credit problem, they have a weakening economy, and monetary policy is what they have. So I think we're in the we're in the middle of a long loosening cycle in China too.
And they have a lot further to go.
Stephanie, Flanders, Martin Wolf, thank you both very much. And thank you for watching. To catch up on this and other topics covered by our analysis team, please go to ft.com/analysis. Until the next time, goodbye.